Well, welcome everyone to today's webinar. As always, we've got a great topic for you. Excited to go through everything. It's one of our more popular webinars that we publish every year. So again, looking forward to going through it all with everybody. Also want to thank everyone for submitting your questions. That does help with the content and definitely as I'm going through today's presentation, providing answers related to those questions in throughout the webinar. So today we're going to talk about the how tax planning changes through the 4 stages of retirement. And that is, something that it does as people enter in these different phases, whether it's kind of pre-retirement all the way to the end of the plan, as we like to say. There's different tax strategies that we employ here at Keen Wealth. And yeah, a little bit about who we are. My name is Matt Wilson. I am the president and chief investment officer here at Keen Wealth Advisors. And, hopefully today's presentation, you learn a little bit. I know we've got a lot of clients on today's webinar, but folks that aren't client as well. And, if you're a client of the firm, know your planning team is providing the information to you that is relevant to your situation. So, it's not like you have to bring this up, but want to just help people be more educated about everything that's available to them or strategies that we're employing, just more in-depth analysis about why we do it and the benefits to you. We have a ton of resources available. You can plug in a lot of different ways. Visit our website, keenwealthadvisors.com. Go to the Retirement Resources tab. There you'll find our blog and podcast, and also a page that hosts all of our webinar replays. We also have a best-selling book. Mr. Keen wrote this book, Keen on Retirement, Engineering the Second Half of Your Life, still very popular. I know a lot of folks on today's webinar have a copy of the book, but if you'd like us to send you a new copy, if you've worn through it too much, or if you'd like us to gift it to someone on your behalf, we're happy to do that for you. Just send me an email to mwilson@keenwealthadvisors.com and we will get one sent out. And then finally, our newest resource is our YouTube channel. And you can go to the YouTube channel and subscribe and see our additional videos. We've been publishing our podcast in video form, and you can find that at YouTube. Yes, so today's topic, tax planning through the 4 stages of retirement. And I start today's webinar off with a question. So this is a question for all of you to kind of answer at home, see if you know the answer. So we have a gentleman, Bill. He's retired, and he has taxable income. He's single filer, taxable income of $48,538, which puts him right in the 22% bracket. So if you go over here to the right-hand side, 2025 IRS single filer tax brackets. As your income increases, the percentage tax you pay on that additional income goes up. So it's like, you're not paying that percentage tax on all of your income. It's just the incremental income. So he's just into the 22% bracket. This is made up of 2 sources of income. $40,000 is coming out of his IRA. And then he's also receiving Social Security of $37,500. And the question is, he's going to go to a concert and he needs an extra $1,000 and he's going to pull that from his IRA. How much tax would he owe on that additional $1,000? So it's common, when I ask this in person to get answers that are, 22%. Maybe some people add in the state tax. This is just federal tax only. And it's very common to see 22% because he's in the 22% tax bracket. And it's the incremental income that would be applied to that federal tax rate. However, the tax code's not that simple. As much as we'd like it to be as simple as possible, it's not. That $1,000 distribution cost him $407 in tax. That's a 40.7 tax rate on that incremental income. And it's because, the tax code is complex. There is a different formula for Social Security and the tax that applies to how much your Social Security is taxable. Everyone gets at least 15% of it tax-free, but you might get all of it tax-free. And this is what happened in Bill's situation. I've got more kind of details in some future slides here to kind of show how that played out. You also have deductions. You have the standard deduction, what's available to everyone. It's the amount that everyone gets off their tax return tax-free, just right off the top. But then you have itemized deductions. So if you have certain expenses such as charitable contributions, mortgage interest, state and local taxes, if they're over a certain threshold, over the combination of those, or over the standard deduction, then you can do what's called itemize your deduction. So you get a larger deduction. There's a net investment income tax. There's additional Medicare surcharges. Then there's capital gains brackets, which are different than the ordinary income bracket. So again, it is complicated. And what we find is that folks that they come down and meet with us, and if they don't have a tax plan, they end up paying more taxes in retirement than they're expected because this system is complicated. And they don't know what's available to them. Even if you file your taxes yourself and you utilize software, you're very in tune with a CPA, there's nothing wrong with working with a CPA or a tax professional, but tax planning is the process of evaluating your tax situation during the calendar year. So that's from January 1 to December 31. It's the moves we make during the calendar year. Like right now, many of you are preparing your 2024 tax return. Well, that is history. That is what happened last year. And if you're working, yes, you might be able to do a few things where the IRS allows you to make IRA contributions, Roth contributions for the previous year. Things like that are available on a very limited basis. But most of the things that you have to do to minimize your tax situation have to be done last year. So you're getting aware of what your tax bill is right now, but there isn't much you can do about it. And again, that's kind of when you're working with a CPA, unless you're sitting down on a routine basis and going through your entire situation, which is difficult for someone to do because there's just a lot of moving parts to it. So the 4 stages of retirement. So you have the pre-retirement years, and that's when we engage with a lot of folks. They're still working, they're still saving. A lot of things are on autopilot, and there are definitely some things that you can do in your pre-retirement years, whether it's maximizing the 401k on a traditional basis, so you're minimizing your current tax bill because you might have a lower tax bill in retirement. So there's what we call tax arbitrage. Pay less today and also pay less in the future. Things like that during your pre-retirement years. Then you have the early retirement. A lot of times we say the go-go years. So that's when folks are the most active. If they like to travel, they're doing a lot of that. They're potentially moving closer to children and grandchildren if that is something that's in the works for them. Then you move through to middle retirement. Things start to slow down. Still not, still active, but as you get older, just doing a little bit less. And then the late retirement years, when there's just what we say the no-go, meaning just less likely to be traveling and doing a lot of that. So these different stages have different strategies to minimize. Really what we're looking to is to minimize your lifetime tax bill as best we can. We don't know what the future holds. We can use the current tax system and kind of talk through what we think might happen in the future, and also your view of the future as well. I mean, we want to make sure people are on the same page And, again, because it's all about making educated decisions in the moment with the tax laws as they sit today. So yeah, that example that we started off the webinar with, it's what we call a tax trap, and Social Security is really the culprit here. And I'll show you how that works, because here's Bill's 40.7 tax rate, and I'll show you how this happens. So he had IRA income, Social Security benefits, his adjusted gross income. So there's some math in the background that you're not seeing here. So that is the amount that is, flows through on the tax return, because it factors in the taxable portion of his Social Security, because not all of his Social Security is taxed. So the way that formula works, that knocks down his Social Security to just a fraction of where it's at. Then from there, he takes the standard deduction, so that comes off the top, and that generates his federal income tax. When he pulls out an extra $1,000, you can see, well, one of the biggest differences right there is his adjusted gross income went up, which increased his taxable income, which increased his tax liability. And why did that happen? Well, that happened because Social Security, it's a formula, and it's defined as provisional income, and it's 1/2 of your Social Security plus all your other income. And if you're single, if it's over 25,000, or let me restate that, if it's under 25,000, you pay no tax on your Social Security. So if that calculation, half your Social Security plus your other income, is less than 25,000, Social Security is tax-free to you. If that amount is from 25,000 to about 32,000, 34,000, in that range, then half of your Social Security counts as income, and it's, a sliding scale. So what happened is, as his IRA income went up, that pushed more of his Social Security into the tax bracket. So that's what he was hit by, 2 taxes in this scenario: the ordinary income plus the additional income from his Social Security. So that's where the 40.7 tax rate comes from. Medicare also has to be factored in. If you're 65 and you're eligible for Medicare, and you're on Medicare, the way they determine your premiums is the IRS, and this is administered through Social Security and Medicare. They look at your tax return from 2 years prior. So let's just say you're 65 in 2025 and you're eligible for Medicare and you're going to sign up for Medicare. Well, your Medicare premium is going to be based on your 2023 tax return. So this is even tax planning 2 years in the future when you look at Medicare and the Medicare surcharges. So here's an example to kind of walk you through how this all works. So we have George and Martha. They have Medicare Part B and D. So there's 4 parts to Medicare. Part A is the hospital insurance, and there's no premium associated with that. You've paid for that throughout your working career, so they don't charge an additional premium for that. Part B covers your medical insurance, and that is standardized. You get a policy that covers 80%, and there's a cost for that, and that's where these IRMAA surcharges come in. And then there's 2 ways you can work with the other 20%. You can go kind of what they say original Medicare or traditional Medicare and just purchase an insurance policy to cover the difference, or you can go through what's called Part C, which is Medicare Advantage. And then Part D is the prescription drug coverage. And, there's a standard premium for that. And then there's additional surcharges if your income is high enough. So George and Martha, they have $334,000 of modified adjusted gross income in 2023. So again, part of why the tax code's complicated, it's like, well, wait a minute, Well, what's modified adjusted gross income? So that is all of your income plus tax exempt interest or tax-free interest. So if you happen to own municipal bonds and you own those outside of a retirement account, that's typically how you would own them. You'd own them in a taxable or a brokerage account, and they pay interest. Well, that interest is tax-free. That's how the tax code allows those. Now they pay a lot lower rate too because the interest is tax-free, but that is something that that people might have in in retirement is some tax-free income, and that gets added back for this calculation. So it's still federally tax-free from the federal tax brackets, but for purposes of determining how much your Medicare premium is, the IRS is looking at all that tax-free income. And this is from 2023 because we're looking at their 2025 IRMAA surcharges. So they're going to sell stock for $1,000. And the question is, what's the tax on the $1,000 gain? So yeah, they sell a stock and they have $1,000 gain. They might, the principal proceeds might be $50,000, but they only have $1,000 gain, which is the only taxable portion of this stock sale. And this is, again, outside of their retirement account. This is in a brokerage account. The common, if you're really up to speed with the tax code, you might think, okay, they're going to own capital gains tax because that's what applies here in this situation, which is 15% currently, plus there's a net investment income tax of 3.8% when your income is over a certain threshold. So that's another $38. So 3.8% plus the 15%, so they'll pay 18.8%. That's the common thought process, especially if you know enough about the tax code to even get to that answer, because that's complicated in and of itself. Well, here's what happens. As your income is higher in retirement, your Medicare premiums go up. Now the threshold is fairly high. For single filers, if your modified adjusted gross income's under 106,000, or if you're married, it's double that, 212,000, you pay the standard Medicare Part B premium. So this applies to everyone, $185. Everyone pays that. There's no additional cost. But then as your income goes up, you can see as these kind of different brackets, the total monthly amount here in this column, and then that's the additional amount you would pay. So if you're $1, and this is a cliff, if you're $1 into the next bracket, you and whoever else is on your tax return that's on Medicare, so if you're both you and your spouse are on Medicare, are each going to pay an extra $74 if they're $1 over this 212,000. That is just for the calendar year, so this would just apply for 2025. And then at the end of 2025, you're going to get a letter from Medicare that's going to state what your 2026 Medicare premium is based on your 2024 tax return. So again, it's a moving target over the course of a couple years on how they calculate this. In our example with George and Martha, their premium increased from $185 each to $480.90, which is an additional $295.90 per person for the calendar year, based on where their income landed in 2023. Part D, that's the drug coverage. Depending on the plan you pick, that's you're going to just pay the standard premium. It depends on the prescriptions that you're on. I mean, we've seen anywhere from $10 to $40 a month, somewhere in that range. Again, there's a lot of variables on the prescription side because everyone's situation is different when it comes to that. But then they're going to tack on what they call this IRMAA, a surcharge, income related monthly adjustment amount is what IRMAA stands for, based on your incremental income over those same thresholds. So the thresholds are the same for single and married filers. And you can see where George and Martha came in. They're paying whatever their standard plan premium is, plus $57 a month each for their Part D coverage because of their 2023 tax situation. So let's add that all up. So their extra Part B plus the Part D, you've got George and Martha each year, combined $3,182.40. So that stock sale, so this is to bring it all together. The example that we used was that they had $334,000 of income, which was $1 less than it wouldn't have put them in the in that higher threshold. The $1,000 additional income of capital gains pushed them into that next bracket. And the way these IRMAA surcharges work with Medicare, it's a cliff. You're $1 over, you pay all the additional surcharges. So they sold that stock for a $1,000 gain. They pay that capital gains plus the net investment income tax. So they pay that 18.8% plus it triggers these IRMAA charges. So you have the $188 plus the $3,182.40 to give them a total really tax liability of $3,370.40 with just $1,000 of additional income. That's a 337% tax rate. When you think about it, it's like, wow, that is a lot on a percentage basis. It's like, well, how do we avoid that? Well, again, it's back to tax planning. It's how do we manage your tax situation on any given year, kind of based on where you're at currently, what your income needs are, what's the makeup of your investments, what kind of accounts do you have, because that does play a factor into the tax planning. And then what our projections are for your lifetime tax bill. And then in addition to that is then, well, when you pass away, if you're married and if you have children, what's their tax situation look like? So there's a lot of things that can go into play here. If you're not married or if you don't have children, then the tax strategy could be different than someone who's married with children. So we personalize the tax plan to everyone's situation. This example here that we have with Sam and Mary. So we've got Sam and Mary. This is related to which accounts should they take distributions from to minimize their tax bill, kind of maximize their tax planning. So Sam and Mary, they need $8,500 a month after taxes to live on. Sam and Mary each have an IRA, $450,000 each. They each have Roth IRAs, $60,000, and then they have a $300,000 in the bank, in some money market and some CDs. So where should they pull the money? So the conventional wisdom, and this is common for a lot of folks that we sit down with that are aware of this, they come in and they know where they want to pull money from, or at least this is their thoughts, and this is part of our conversation with them is, hey, have you thought about which accounts you're going to pull distributions from? And if you don't know, that's completely fine. We'll walk you through the strategies and the tax liabilities related to each one of them. But conventional wisdom is that you would spend the taxable money first. So let me just go back a slide. You'll spend the joint bank account down first because they need $8,500 a month. So that's just over $100,000. So they could spend that down over the course of roughly 3 years, because if you factor in some interest they're earning on that lasts them about 3 years. About $102,000 is what they need on an after-tax basis annually. Then once that money is exhausted, they would then start to spend the IRA money, which is tax deferred. And that money, when it comes out, is you pay ordinary income tax when it comes out because you've been deferring the tax in those traditional IRAs up until the point you take a distribution or until you reach your required minimum distribution age, which is when you're forced to take a distribution from your IRA. And then the last bucket that you would touch would be your tax exempt money, which is your Roth IRA accounts. And the reason that you would hold off on spending that is because when you put money in a Roth IRA, you're paying tax in the current year. And you can put money in a Roth IRA two ways. If you're still working through either the Roth 401k, if you have access to that, or a Roth contribution, assuming your income is, under a certain threshold, you can make those deposits while you're working. The other way to get money inside an IRA is through a Roth conversion. So you take money out of a traditional IRA and you pay the tax and then convert it to a Roth IRA. And that is available to anyone. There's no income thresholds, no requirement to have earned income like there is on a Roth contribution. Because you pay that tax, the benefits to this money are accrued over time by growing tax-free. So the longer it grows tax-free, the better the benefit is over your lifetime. But here's the alternative approach to this, because it's like, okay, well, is there a better way? And we believe so. It's one minor tweak, and it's utilizing what I just mentioned. It's a Roth conversion. So you're still spending the taxable money. That $300,000 in this example that's in the joint account that's invested in money market and CDs, they're going to spend that down. But at the same time, they're going to convert some portion. We're going to do the tax planning and determine the amount and how much they should do from their IRA to their Roth IRA. And the reason is because if they're spending their taxable money first and they don't have any other income, they're not working, there's no, they're not claiming Social Security, they're not receiving a pension, they have no rental real estate properties, things like that. So their only income is whatever the interest they receive on these accounts on an annual basis. On $300,000, let's just say it's 5% interest, not quite that high today, but let's just, for simple math, that would be $15,000. And if it was all taxable, well, the standard deduction for someone is over $30,000. So they would pay no tax. So they would have, while they're spending down this taxable money, they'd be in a 0% tax bracket. And that's why we look at converting money from the IRA to the Roth IRA. And it's because you're in a low tax year. So let's utilize those low tax brackets and pay a little bit of tax today, put that money in the Roth, and it's going to grow tax-free for the rest of your life. And we do this in the context of looking at your lifetime tax situation. Again, it's based on estimates of what we think is going to happen in the future, current tax law, your thoughts too on future taxes. And if we can minimize your lifetime tax bill with utilizing Roth conversions, we're going to talk to you about that. So you convert some money to the Roth IRA. Then once this money's exhausted in the taxable account, then you start to live on the tax deferred money. You still may convert money to a Roth IRA. You may not. That's a whole different strategy. And then spend the tax exempt money last. So that's a way to think about how the different types of accounts you have factor into the tax planning. When we talk about Roth conversions a lot with a lot of our clients, and part of it is just, hey, current tax law is set to sunset at the end of this year. Now, with the administration and the makeup of Congress, it's likely that those will be extended, but again, until that passes, we don't know what that's going to look like. So we're currently potentially in a situation where taxes are lower than they will be in the future. Now, the other thought too is that the government is running massive deficits, and there's just been a lot of government spending, and it hasn't just been recently, it's been for a long time, and the national debt is building up, and at some point our tax is going to go up. It's hard. Here's the way I like to look at it. It's like, it's hard for me to see situations where taxes go down significantly in the future. It could happen, but probably won't be significantly less than where they're at today. And so when you convert money to a Roth IRA, what you're doing is you're locking in current tax law. So you're eliminating the risk of taxes going up significantly for you in the future when you convert money to a Roth IRA under current tax law. So that's why, we talk about that, because and there's a threshold, because sometimes we get the question, okay, well, why don't we just convert all of it to a Roth IRA and we don't have to worry about this again? Well, as your income goes up, that's what these buckets represent, the current income, federal income tax brackets. As your income goes up, the percentage tax you pay. And if you have a large IRA balance and you're paying a lot of tax plus the net investment income tax and all this, other things that gets added onto it, you could see, if you have state tax as well, I mean, you could see a 40 to 50% tax liability of the entire balance, due when you file your taxes. And it would take a long time to make up, from an investment earning standpoint, that much of a tax bill. But if you're in the lower brackets, like my example with Sam and Mary, they're in the 0% bracket. So we would talk to them at a bare minimum of it converting in the 10 to 12% bracket, because they're in a very low tax situation currently, and we want to maximize that for them. But let's say you're already pulling out distributions from your IRA, you're receiving Social Security, and you're in the 22% bracket, like Bill from our first example here. Well, just one thought, because again, it's like, all right, how much should I convert? Here's just a kind of back of the napkin is, well, maybe look at just filling up whatever the current bracket you're in. So in Bill's example, we'll just talk to him about that 22%. We'll run analysis and say, well, what if we converted in the 24? How does that impact your lifetime tax liability? And in some cases, yeah, you see one diminishing kind of return there, meaning you're seeing less and less incremental benefit by converting in higher and higher brackets, and then even at some point there it flips over to be kind of negative for you. So we're able to do that analysis on an annual basis and talk through it with people about how much should they convert based on current tax law and their current situation. And we do this every single year. We can have a strategy that we're implementing and executing on, and then as tax law changes, adapt it. That's the benefit to it. It's not like you're locked into doing something every year for the rest of your life. So again, look at Roth conversions when you're in low income years. If you happen to be a business owner, if you have a bad year because you have low sales, or if you have a lot of expenses, you might have a loss on your business, and you can potentially, of course, work with your tax professionals on that, carry forward those losses on a business side, or utilize them against a IRA distribution. So kind of depends on what you think is best for you. Also, if you have high non-recurring medical bills, so what that means is that you're able to deduct medical expenses over and above a certain threshold. So it is not common for people to really get a major benefit from their medical expenses, especially for routine medical situations. However, if you have, here's where we see this example come up. If you happen to move into what we would, assisted living or retirement community that has an upfront cost to it, and part of that cost could include medical expenses, like almost like prepaid medical. And we had a situation with a client who moved into a retirement community, had to pay an upfront cost to do so. And we were able to convert $100,000 out of their IRA into their Roth IRA with no tax liability because of the way the deduction on their medical bill worked. Now, if you're in a long-term care facility and you're in there and the expectation is going to be in there for several years, well, that would be considered a recurring medical bill. Now, that still might mean that you should convert money to a Roth IRA. We would work with you or your powers of attorney if you're not able to communicate about, hey, what is your current tax bill? That's part of that end of retirement tax planning, when it comes to that, is how do we minimize your tax situation at that point, plus maybe even set it up even better for your beneficiaries. Yeah, looking at the tax bracket, if you've got highly appreciated stock, that's also another thing to look at, especially outside of, this applies to accounts, brokerage accounts outside of your IRAs. If you're in the first two brackets, you could potentially sell that for no capital gain. We call that gain harvesting. Here, as we kind of progress through, now we're in the go slow years in mid-retirement, and we're talking about charitable giving and how that applies as you age and get to the point of required minimum distribution. So here, a couple of things. We've got Albert and Shirley. They're in the 24% bracket, and they currently give about $5,000 a year to charity. They have $15,000 of existing itemized deductions. So you combine those two together, $20,000 total itemized deductions. Well, that's not over the standard deduction. Plus, because they're both over age 65, there's an additional age 65 deduction for each of them. So the total standard deduction for them would be $33,200. Well, their itemized deductions are only $20,000, so they would claim the standard deduction because it's better for them. So there's no federal tax benefit for them to make a $5,000 donation to charity. Now, that's not their reason for doing it. It's not for the tax benefits, but when we sat down, with them, what we're looking at is, well, how can we set up your situation to where you could get a benefit from, a tax benefit from making these charitable contributions, because their plan is to continue to make them every year into perpetuity. Well, one of them is utilizing what's called a QCD, or qualified charitable distribution. So this applies to your IRA, traditional IRA specifically, and it's once you hit the age of 70 and a half, you're eligible to do this. So you have to be past that age, actually, past that birth date of 70 and a half. And current law says that you can take out up to $108,000 from each, from your IRA. And if you're married and your spouse has an IRA, it applies to them to that same amount as long as they're over 70 and a half. And that's each year, and it's adjusted for inflation now, so it's going up each year too. But $108,000 on an annual basis that you can gift out of your IRA directly to a charity. So in their situation, they're over 70 and a half. So we talked to them about this, and you have an additional added benefit if you're at RMD age. So that's the age you have to start taking mandatory distributions. RMD stands for required mandatory distribution. If you're at RMD age, which is age 73 currently, that amount that you take out as a QCD also counts towards your required minimum distribution. It's not an itemized deduction because it comes off right above the line of your adjusted gross income. So it is a very good way to give to charity as you kind of hit these age thresholds. So here's an example. So this is what Albert and Shirley were doing currently. They were donating $5,000 to the charity. Now, what they were doing was they were pulling it out of the IRA, and because they're at RMD age, it was counting towards the amount that they are forced to take out. So it satisfied a portion of their RMD, but it shows up on their tax return as income. They're in the 24% bracket. So the tax bill on this $5,000 distribution is $1,200. And they're not itemizing. So that's not, it doesn't come off as a itemized deduction on the charity side. if they utilize a QCD, and all this is just, it's almost like accounting, but there's some very specific things that have to happen. You still give money to the charity, but it comes directly out of the IRA and it goes directly to the charity. It satisfies the RMD still, but it's excluded from your taxable income, meaning your tax bill is now zero. So that just saved them $1,200 on that that donation to charity. So the only person missing out on this, or the only entity, is the IRS, the government. So a very, very good strategy, very common strategy for folks to utilize. And most of the major custodians, and this is very easy to execute. You can write checks against your IRA, and as long as it's direct to the charity, that's the key. It cannot go to you first and then you send it to the charity. You have to send it directly from the IRA to the charity. And again, not complex to do in by any sense of the word. So now tax planning. So as you age and we get into the late stage of retirement, people are always thinking about the estate plan just in case something happens unexpectedly. But then essentially as you get older, we do know that life expectancies aren't unlimited. So there is a point to where, yes, this money is going to transfer either to a spouse or to your beneficiaries. And how can we transfer the money? How does that work, and how do you maximize it from a tax planning standpoint so you minimize your tax liability? So here we have an example with Phil and Mary. And Phil, they have a taxable account, so similar to Sam and Mary, where we had $300,000 in a taxable account, money market CDs. They pay tax on the interest and any capital gains they realize on an annual basis. That's how taxable accounts work, different from IRAs. And they have some investments in that. It's set up as a joint account with rights of survivorship, meaning if one of the owners, so if Phil or if Mary pass away, the surviving owner maintains control of the account. And the investments in that account have an unrealized capital gain of $120,000, which is all long-term. So what that would mean is that if they sold that account out completely, they would have capital gains, they would owe capital gains tax on $120,000. Well, in this situation, Phil's diagnosed with a terminal illness and he has 18 months to live. So if they don't do anything, here's how this would work. So Phil would pass away, Mary inherits the account, so she would get, she'd become the sole owner. And the current tax law allows a step up in basis. And so that step up would be on half the account because only one of the two account owners passed away. So of that $120,000 long-term capital gain, 60,000 of it would go away. That just happens automatically. Essentially from a functional standpoint, it's like the cost basis that's in the at the custodian gets adjusted. So now if Mary sold the entire account out, she would only owe she'd owe capital gains tax on $60,000. She could liquidate the entire account and basically cut her tax bill in half. Had they, liquidated it prior to Phil passing away. If they utilized just a little bit different strategy where they move all of the investments into Phil's name. So Mary, they just transfer it to an individual account, and you can set up a transfer on death to where it would transfer automatically to Mary. She just isn't necessarily an account owner, but she could have power of attorney on that account, and she can act on that account just like she was an owner for the most part. But it's all in Phil's name. And then he passes away 18 months later. Well, because there's only one account owner, the step up in basis applies to the entire account. So that long-term capital gain, and the tax bill associated with that of $120,000, that would be eliminated. It'd go to zero. Then Mary inherits the account. Again, it transfers at death to Mary. That's what the TOD stands for. She would have that entire account available to her with no tax liability. So again, certain things to think about when this applies to you and these situations arise. And definitely when you have a diagnosis like that, I mean, it's usually not the first thing you think about is, oh, how can I maximize my tax plan or minimize my tax bill. But over time people do start to think about that. It's like, well, how would this assets transfer? How do I make sure my spouse or surviving spouse is taken care of, or my beneficiaries? Are there things that you can do while you're still living to help that transfer of assets and minimize tax liability related to that? Now, IRAs have some unique transfer tools. So when I use that example with Phil and Mary, they have a joint account, and so that joint account it transfers to the surviving owner automatically, or you can have an individual account with a transfer on death, so it automatically transfers. You might have a trust account that is established, and that would say what happens at the passing of the trust, whoever created the trust. IRAs, they have beneficiaries, which is similar to a transfer on death. So it's who gets this money when I pass, and you have primary beneficiaries and contingent beneficiaries. So it's important that you have them listed, because if you go through the estate planning process and you set up a will and you set up a trust, but you don't name any IRA beneficiaries, it doesn't matter what your will says. It goes through probate, and then through the probate system they're going to look at what your will said and everything else, but it's costly and it's time consuming. It can take a long time to go through probate, and this money's tied up, and it's very, very complex and difficult. And while if you're a beneficiary and you fully expect to receive the money because the will says that, you can't access any of it while it's until it transfers. So going through probate is definitely something that you want to avoid. So you want to have IRA beneficiaries listed, and you want to make sure they're up to date too. It's common to see someone list their spouse as their primary beneficiary and then children as contingent beneficiaries. Very common way to see that. If you've set up a trust, you might list your trust as a beneficiary to your IRA as well. I mean, it's just depends on your personal situation, what makes sense for you, but making sure that is updated is crucial. Now, there are different types of IRA beneficiaries, and this isn't something that you define. It's not like you select which type of IRA beneficiary. You select the type of IRA beneficiary by whoever it is you name, because that is what determines what type they are. So here are the different types of beneficiary. You have non-designated beneficiary. So that's your estate. If you don't name anybody, that's what that means. There was no designation. If you list a charity, they consider that a non-designated beneficiary. And a charity, the way that works is that if a charity inherited your IRA or a portion of it, because it could be a percentage, doesn't have to be the entire balance, the charity receives that money tax-free because the charity doesn't pay any tax. So that is definitely a strategy to utilize in your estate plan if you are charitably inclined. And then you have certain trusts where this would apply. Most trusts that you're going to write, as any person listening to this webinar, they're going to follow or fall under the non-eligible designated beneficiary. And this is where there's been some significant changes over the last several years related to how this works. So non-eligible designated beneficiaries, so those are typically non-spouses. So children might be a sibling, and then pretty much any of the trusts that we're, again, for folks that are on here are going to set up, are going to follow under that designation. And then the last beneficiary type is what's considered an eligible designated beneficiary. So that would be minor children, if you're considered disabled, if you're chronically ill, not more than 10 years younger. Again, certain trusts, but very not common. And then spouses. And it's just the rules for how that money is transferred and then how long they have until they have to take a distribution is different based on these different types of beneficiaries. For all non-eligible designated beneficiaries, I mean, basically, you've got 10 years to distribute the account. So it has to be kind of completed by the end of the 10th year. And if you're at the age where you're taking required minimum distributions, they have to continue that too, each year while they're waiting. They just don't have to take out the corpus of it until the end of the 10th year. And there's a lot of planning that we help beneficiaries on related to that. Again, that's most non-spouse beneficiaries. So think about your children, and then the trust that you would create would pretty much fall under that as well. Eligible designated beneficiaries, so those are spouses. Again, disabled people, chronically ill, individuals that are not more than 10 years younger, so could be a sibling, and then minor children. What they have is they don't have that 10-year window. They have the ability to stretch the IRA over their lifetime. So what that means is that there's a calculation. That was the old rules prior to the passing of the Secure Act 1.0, when they increased the RMD age from 70.5 to 72. It's now 73. It's been slightly increasing. When they increased those RMD ages, they got rid of the stretch IRA for most beneficiaries, except for these that are listed here that are considered eligible designated beneficiaries. Well, how does it work with a spouse? So with a spouse, so you pass away and you have your spouse listed as a primary account owner. There's a couple of things to think about. So the spouse, if they have their own IRA already established, they can roll it into that account. If they don't have their own IRA established, essentially they would create one and then your account would become their account. I mean, it's the assets just transfer. So in that situation, whether they have an IRA, don't have an IRA, really the solution is the same. And they're the owner of the account. And that applies, it's just like they own the account forever. The IRS treats it just like you own the account, just like they own the account. The other option they have is they can elect to set up what's called an inherited IRA. Well, why would someone do that? Well, an inherited IRA that has this, forced distributions if you're over your required minimum distribution age, or if you have to take out money within the 10th year. That's what inherited IRAs are. So why would they want to set this up? Well, in the situation where the spouse was under age 59 and a half, so your surviving spouse is under age 59 and a half, and if they selected the spousal rollover, or if they just opened up their own IRA and became the account owner, IRA owner, they'd be subject to the 10% early withdrawal penalty for any distributions taken prior to 59 and a half. So let's say they're age 55. Well, we could set up an inherited IRA for them, and then they can have access to the funds with no 10% penalty. And then once they reach age 59 and a half, the IRS even allows them then to convert it back to a traditional IRA. So, it's kind of like you have to go through a few of these hoops, but surviving spouses get very special rules and are treated very well in the tax code when it comes to these IRAs and making sure that they're able to access the funds with really as penalty free as possible. But you do have to do certain things. It's not automatic. It's like if you don't select certain things, if you don't select the inherited IRA in this situation where you're under age 59 and a half, you can't go back and change it. So if you select the rollover and then you need it, well, then now distributions are subject to that 10% penalty. So something to just be aware of, depending on your age and the age of your spouse and how your beneficiary designations are set up. So that's, why we sit down with folks and work with them as, especially when they're married as a couple, because we want to have both spouses understand how all of this works and be on the same page as well. And in some cases, maybe someone is just less, in tune with some of it, but they know who we are and how this is going to work should something happen. And we're able to walk them through all of this and set up this stuff for them. So it's in a very beneficial format from a tax standpoint. So I know we talked about a ton on today's webinar. And again, I appreciate all of you for joining us. Appreciate the questions too. We were able to answer several of them throughout the webinar, but what we're going to do is we're going to record a podcast episode where we'll answer all the questions that came through as well. And yeah, just, when you think about, especially if you're in this pre-retirement age, I mean, we sit down with a lot of folks kind of as they're gearing up for retirement, as they're, transitioning from working into retirement, and that can take several years, because you might want to fund Roth accounts. There could be, utilizing backdoor Roth. There are things that you can utilize before you retire that, that we can help set up a very good tax plan for you and your spouse, if you're married, or the rest of your family, depending on how your situation works. And then as you move into retirement, decisions around Social Security and when to take it, because there's a lot of tax thoughts around when to take Social Security too. Utilizing low income tax brackets via Roth conversions when you're able to, understanding those IRMAA Medicare surcharges if your income is over certain thresholds, and then managing your required minimum distributions too, and how to maximize, charitable giving if if that's important to you, and then again passing your assets on to the next generation. A lot of things related to that as well. And we just covered just a handful of the topics. I mean, there's a lot more that goes into this. Other strategies around the charitable giving side, other tax strategies where maybe I mentioned it briefly, but to go through all those examples would probably take us several hours. So we wanted to hit the high points here. And so this is where, again, if you're a client of Keen Wealth, your planning team is going to go through all this with you through our annual tax planning conversations with you. But if you're not a client, we have a team of CFPs here that can go through this process with you. And there's no cost or obligation to have a conversation with us. Even sit down with us. We'll put some baseline scenarios together, walk through that to show you, because it's like we can show you visually on how your tax plan looks today and then how it changes when you factor in some different tax planning strategies. So again, encourage all of you to take us up on that offer, because it's something where you might even just learn something. There may not be a fit for us to work together, and you might be doing everything as best as there could be. But there also might be, maybe you are doing all that, but you're worried about your spouse and what's going to happen to them, because they're maybe not in tune or not as interested in this as much as you are. And that's very common for us to work with folks that are, concerned about that. Again, check us out, keenwealthadvisors.com. Go to our retirement resources tab, find all of our content that's published every single week. We have a new blog or podcast published. Mr. Keen's book, Keen on Retirement. If you'd like a copy of that, please send me an email, mwilson@keenwealthadvisors.com. We'll get that sent out to you. And then lastly, check out our YouTube channel. YouTube.com/Keen Wealth Advisors, I believe, is the URL, how you can access that. You can also access it through our website and our retirement resources page. So again, thank you all for joining today's webinar. Again, appreciate all the questions that were submitted ahead of time. Also, the questions that were submitted throughout today's webinar. we're at the top of the hour here, so we will, get back to you as quickly as possible. All right. Have a great rest of your day.